some number of jammed up traders. The beginning of the session, at London Open and US Open, there was a false move to jam up the traders in both sessions and to end the day jamming you up. The end of the session and the end of the week. Friday, they make an aggressive move and pull back against that move to trap the traders into weekend carry. Okay, I'm trying to keep it a little slower so you can write. So think for a minute. They make the false move at the beginning of the London session. They run the trend. At the end of the London session, they will make one more extension, which is false. Then pull back, go into consolidation for the US, and then possibly reverse. End of the session, continue with the trend. Beginning of the session, hit that number again, don't break it, and come back. The end of the day, 4 or 5 o'clock in the afternoon, or if they end the trading day at noon, which a lot of times they do, the price will go back into consolidation, which is the end of their day, and leave you jammed up into the next day. Now think for a minute that I've told you this, that they make these trap moves at those times of day. How many times have you sat there at 1 o'clock in the afternoon all the way into the next night, aggravated that there was no movement in the market? You got jammed up in the consolidation zone and had to sit there until the next night London Open when something started moving again. The beginning and the end of the day is defined as 5 o'clock New York. The end of the day is 5 o'clock New York. It's a 24-hour cycle. I'm going to illustrate it for you in a second here in detail. Understand that the pattern presents on a larger scale throughout the course of the week. Okay, some of you just installed the indicators. I'll give you a brief update on it. These double tracers right here. Let me grab my little ballpoint pen. I'm excited. Okay, these little tracers right here and right here. These two lines. This is Friday. This area is Sunday. This is Monday. This is the beginning of the week. The double black tracer is the beginning of the week. So here you have the week beginning. Market makers make the aggressive move to trap the traders long at the beginning of the week and then pull the market away from those traders. There's your week beginning trap move. In fact, this move just played out in most majors across the board on Monday. They made a triple top high and jammed all the traders and the bottom fell out. My traders caught that move. And I know what happened on the recent one is they made the high Friday. They came back, hit it again in Asia, and at the London Open stop hunt cycle, they hit it again. So you had a triple top high lined up with the London Open. Yes, look at the majors, Sunday, Monday. Okay. Beginning of the session, right? I said beginning of the week. Sunday, Monday, they'll make a jam move, trap the traders long for the week. The beginning of the session. Stop hunt in both directions, which triggers the pending orders. Right? Breakout traders, bracket this. Nice, right there, grab the pendings. They pull back, stops out those breakout traders. They hit them again. They come back, don't allow them to see a profit, shift the zone off of those traders, game over. You got whipsawed long and short in one session. And if you don't have the guts to come back the third time, and a lot of people do not, you're jammed and you missed the trade. Okay? So now you know when you're looking for the false moves. End of the week. Here's Friday. right? Here's my double weekend tracer, Friday, Sunday, Monday. Okay? Here's Friday. Before they end the day, they spike the low, pull back, end the week in consolidation chop. The lower level shorts are jammed for the weekend and got to pay rollover. Right? To add to the beginning of the week, they open with a gap. They didn't used to gap a lot in Forex. A couple of years ago when people got their butts kicked in equities, they started flocking over here in droves to the Forex market because of the leverage, the ease to trade. You don't have to memorize 150,000 stocks. There's a handful of pairs that you can work with. The Forex market started sounding very appealing to people that lost their pensions. Now, because there's more volume, these guys added a gap to their arsenal against you. So what I'm telling you is, in not so many words, or in too many words, don't carry your trades over from Friday into Sunday, Monday. Not necessary. If I told you they're going to jam you on Friday and leave you trapped, and you caught this M in the U.S. session and you shorted here, and you see the hammer to the low and it pulls back, take your money off and call it a good week. Okay? End the day in consolidation, end the week off of the high, 25 to 50 pips to jam the traders, depending on the pair, and I'll talk about that in a minute. Okay? Good stuff. Another Friday example. They went up to the high. Friday, Sunday, Monday. Here's your formation. Here's our entry in our group. This might have been a scratch because you have a big entry bar. We might add a pass on that. I know Jim Nicholson got in right there, though. Okay. If this bar is too big, this is a pass. This is a no entry. Okay, now, here's the gap I talked about. This looks like buy the dips in an uptrend, right? So people got jammed up all in here. Friday, they closed, they stuck them because people thought the market would rally at the end of the day, right? Whatever the philosophy is. They gapped down, hit the stops that were all in this range right here, and all these guys that were stuck long in here, they gapped them right out, with this, hit their stops. Now, the shitty thing about the dealer that he can do about that is this. If the dealer closes at a price point on Friday and he gaps down 100 pips or 80 pips or 50 pips and opens, if your stop was 5 pips below the candle, he gives you the fill at 45, minus 45. How can he do that? I had an order in minus 5 or minus 7. The answer is that is the first price available on Sunday at the open. You were filled at the first price that was available at that level. So you thinking you have a nice stop in place and carrying stuff over the weekend is crap. If this has never happened to you, I applaud you. If you thought about carrying trades into the weekend, this is why you do not. You don't know what's going to happen with the economy the way it is. You don't know if they're going to raise the debt ceiling, lower the debt ceiling, fire the president. You don't know what's going to happen. You don't know if there's going to be some mass exodus in the Eurozone to get out from underneath the euro and there's burning and buildings collapsing over there. You don't know if there's going to be an earthquake. Market makers use that crap as the opening reason to gap the market aggressively against you. It's crap, but it doesn't give you back your lost equity when you hold a trade over Friday. I've seen gaps come all the way back to the low. I've seen sick stuff with the gaps. So what I'm telling you is, in not so many words, is don't carry trades from Friday. Take what's given to you and get out. Okay, now, Here's a typical week. This is the structure that you need to memorize to understand the week. Here's what happens. You know I have the small pattern that I draw for you guys, right? The week is comprised of the same pattern. Why, you ask? The answer is because the behavior is the same on the larger time frames. So the market maker's counter to your behavior has to be the same. So what happens is this. Remember I drew this for you? I don't know if you can see that purple. Stop, hunt, high, drop, pull back, right? That's the intraday pattern as I've illustrated for you before. I'll do it again in a minute. Stop, hunt, high, drop. Now on the bigger picture, consolidation, stop, hunt, low, trap lower level shorts, trigger the stops of the weak long holders, run it up, a big fat M, which is a multi-session setup. By the way, the most powerful setup is the multi-session M and W. What is that? I'm going to show you pictures later, but here's one for you right now. The definition of a multi-session M or W is simple. Market makers hit a level. They repeat the level in another session or another day. This example here is Wednesday. Market makers made the high of the week, the HOW, the how, right? They came back near the HOW, but failed to break it because they had trap volume or pendings at that area that if they come back and repeat the level, the traders are released. Okay? What the hell are you talking about? They release the traders. How many times have you been in a trade and said, if it gets back to break even, I'm getting out? If it gets back to -5, I'll take my lumps and get on with my life. How many times have you said, if it comes near where I got in, I'll just take what I can get and be happy I didn't blow my account? If you said those things to yourself, you're not alone. This typical M&W behavior is based on that mentality or psychology. The traders that think like that because they don't understand the market put their pending orders in around here to get out at break even. They'll put their take profit at +1, 0, -2 just to get their money back and be out. When market makers come near the level, they don't allow that volume to be released back into your accounts. They don't want to release it back into the wild. Think for a minute. If there's $500 million at Wednesday's high or the high of the week, they're not going to break the level. They're going to come near it because, remember I told you they're so greedy, they got to grab whatever money's still there, and then they'll shift away for 3 days. The market is based on a 3-day, 3-level cycle. Write this down. The market is based on a 3-day, 3-level cycle. Market makers will trap lower level shorts, higher level longs, and make a unidirectional swing for 3 days or 3 levels. If you look at this example that's up there, you have a false move week beginning, which is a variation on the pattern, stop hunt high, coming out of Friday, which if you notice, this is exactly what happened this week. They hit it again Asia, hit it again London Open, bottom fell out. Okay? Now, they then repeated this behavior on a 2-day cycle, stop hunt low, jam the traders, run. This run was made 3 levels or 2 to 3 days, approximately. the midweek reversal, which there's a midweek reversal almost every single week. You can have multiple levels in one day. Yes, that would make it a 2-day cycle. Now, Wednesday, they put in the midweek reversal like clockwork right here. They trap for the high of the week. They repeat the level but fail to break it. The spread opens up to pick up any pending orders on the other side of Wednesday's high or the high of the week. If you notice something, the highs of the week will coordinate with the stop hunt triggers at the beginning of the sessions. Think. This is a stop hunt high trap for London. They repeat the same stop hunt in the U.S. session. 2 sessions formed out in the middle of the week at Wednesday after 2.5 days of rise at 3 levels looks like a midweek reversal to me. You then get a unidirectional swing. Unidirectional meaning one.